Welcome to Taking Stock. I'm Amanda Lang. Coming up on the show, G7 finance ministers meet in Canada this week with trade turmoil on the agenda. And Canada's pension plan is large and stable. We'll ask the CEO whether anything needs to change. Plus, steel producers are taking the brunt of tariffs again. Is there a better way? That's all ahead. First, for the week that was in business, it's time for the briefs. Finance ministers and central bankers from the G7 nations met in Alberta this week in a prep meeting ahead of the leaders' G7 meeting there in June. The group avoided any contentious language around tariffs and opted instead for a show of consensus on other issues, including economic security and artificial intelligence. Inflation ran hotter than expected in April once the effect of the carbon tax is removed. The headline rate of 1.7% masked underlying price pressures that could keep the Bank of Canada from lowering rates in early June. CPI median rose 3.2% in April from 2.8% in March.
From a Bank of Canada perspective, it does complicate the easing. It does delay it. I was thinking there was a possibility of an ease at the next meeting. I am now not thinking there will be an ease at the next meeting by the Bank of Canada because of CPI.
Bond rating service Moody's became the latest to downgrade the U.S. debt this week, a reflection of concern about mounting deficits and higher planned spending. The downgrade could make future borrowing by the U.S. government more expensive. The downgrade comes as the U.S. Congress is poised to pass a spending bill that includes an extension of tax cuts for the wealthy that will cost more than $3 trillion. Honda is the latest automaker to scale back its electric vehicle plans. The Japanese firm said weak demand for EVs is prompting a shift to hybrid vehicles, and it's reducing its forecast for EV market share by 2030. This week, Stellantis also delayed indefinitely its plan to produce EV models of the Dodge Charger Daytona in Windsor, Ontario. Subaru of America is the latest car maker to raise prices. Subaru stopped short of blaming tariffs, but cited market conditions for the increase, which could add between $750 and $2,200 US to the price of its vehicles. Earlier this month, Ford raised prices on 3 models made in Mexico by $2,000. And those are your business briefs. This week's meeting of G7 finance ministers and central bankers was overshadowed perhaps by concerns about global trade. But what should G7 countries be working on? Matthew Holmes is Chief of Public Policy at the Canadian Chamber of Commerce. Thanks for being with us.
Great to be with you, Amanda.
So a bit of an elephant in the room here, but obviously it's important when the G7 comes together. From the point of view of the Canadian economy and what we're focused on, what do you think we want to achieve at these series of G7 meetings?
Well, it's an important moment for Canada in 2025 to have the G7 presidency. Obviously, none of us expected or hoped for the global trade war that we're currently living through. But I think Canada has a role to play here in establishing the importance and convening different players from around the world who have been traditional allies to really establish the importance of a multilateral approach about common goals and objectives, and the importance of these liberal democracies to continue to be leaders in the world from an economic perspective and to work together on what that world trade order looks like. This is really the origin of the G7. 50 years ago, it came together to deal with inflation crisis, with energy crisis, and the lack of a rules-based system or a rules-based system in the Bretton Woods example that was falling apart. And to say we are the leading economies, we have a role to play to sort of set the terms and create the certainty that business needs. And I think Canada can help play that role at this time of great uncertainty.
And of course, there are a lot of things globally that we need to be talking about that are on the agenda, things like artificial intelligence, like security amongst countries. The overshadow, though, of the trade relationship feels large. How important is it to just kind of keep things on an even keel as we head towards the June meeting where we do get the leaders together?
Well, I think it's really important, and dialogue is essential to any commerce, right? You don't have commerce, you don't have trade without that first dialogue that happens in a room. And so the fact that we have these leading economies together, obviously they have some differences. They have some tensions. There's the elephant in the room of the trade war and the tariff regime that's being introduced by the US administration. But the fact that they're all there, they're sitting around the table, they're agreeing on the things they can agree on is important. And when we saw the foreign ministers meet earlier this year in Charlevoix, we also saw that they actually came out of that meeting with a fairly robust list of things they'd agree on. Of course, there were things that were missing and others that people might have wished that they could come to consensus on. But the fact that they're there, that senior representatives of all those governments are participating, and that they're leading towards this leaders summit in June is in its own right very important at this time.
So good to have you, Matthew. Appreciate your time.
Thanks for having me on, Amanda.
Matthew Holmes is Chief of Public Policy at the Canadian Chamber of Commerce. Coming up, Canada's pension plan is large and stable with growing power in the world. We're talking to the CEO of its investment board after this. Welcome back. Canada's federal pension fund is one of the largest in the world and stable for a couple of generations. Here's what you need to know. The Canada Pension Plan was founded in 1965 to address poverty among seniors with a target benefit of 25% of a worker's average lifetime earnings up to a maximum amount. At first, benefits were supported by current worker contributions, but the aging workforce made that untenable. So in 1997, the plan was amended with contribution rates doubled to 9.9%, paid by both employee and employer, and a reserve fund created to help cover the fund's growing liabilities. In 2016, benefits were increased up to 33% of lifetime earnings, and the maximum was raised to $20,600. At the end of fiscal 2025, the fund had $714 billion in assets and a 10-year annualized return of 8.3%, generating $355.8 billion in income. The fund is stable for the next 75 years and is projected to grow to $3.5 trillion by 2050. By the end of 2025, 12% of its assets were invested in Canada, 47% in the U.S., 19% in Europe, 17% in Asia Pacific, and 5% in Latin America. As of January, a newly retired person received $899.67 on average, and the maximum monthly amount was $1,433 per person. When it comes to the CPP, most Canadians care that their pensions are safe, but the fund is also a major player in the world of investing and has a fair amount of clout. John Graham is president and CEO of the CPP Investment Board. Thanks for being with us.
Thanks for having me.
So let's start with the overall notion of safety. We know from an actuarial point of view, it's been deemed safe for 75 years. When Canadians think about the CPP, how do you think they should think about it? Is rock solid?
Yeah, absolutely. And as you highlighted, the Office of the Chief Actuary comes out every 3 years with a review of the plan. And CPP, as of the last review, is sustainable for 75 more years, which is actually a remarkable achievement if you think about the pension systems around the world. And Canada has one of the strongest sustainable pension systems, one we can all be very proud of.
And of course, it took some doing to get there. Are there likely to be other changes? There have been these two amendments over time, last one back in 2016. Do you think that, under your management, we might see the size of the, benefit increase or the size of the investments put in increase?
Well, that really is a question for policymakers. The provinces and the federal government really decide the contribution rate and the benefits. But as you highlighted, it's been 25 years, just over 25 years since CPP Investments was created. First check came in $12 million. As you saw, we just announced $714.4 billion. Mm-hmm. So I think a tremendous success story, and we'll continue to manage that money in the best interest of Canadians.
So on that front, the long-term return of the CPP, I think your most recent report has it just above 8% over a 10-year period, which is certainly healthy enough to match your liabilities. There's no doubt about that. One wonders, of course, John, with a fund of this size, whether it gets harder as you go to find investments because you've got such a big pool of capital.
Yeah, so our 10-year returns are 8.3%. And I think one of the stats we're most proud of is since inception of CPP Investments, $492 billion of the $714 is from cumulative investment income. But you bring up a good point around going forward returns. Now, we actually view scale as a comparative advantage, and we've built out a global capability to be able to invest in all the big economies and all the big asset classes in the world. But as we look forward, we certainly do view that across the entire globe, investment returns are going to be harder and harder to come by, and we're going to have to fight for every basis point and we're going to have to look to continue to contribute alpha to the portfolio.
And on that front, as a major investor, obviously you'll be watching the U.S. and its trading relationships closely. And I wonder what your thought is about the long-term shift in, and I'm focused here on the public market, so the stock market of the U.S. People talk about a multiple reduction. In other words, just a change in the value of stock markets there that might change our thinking long-term. Can you look through that, or is that something you need to think about over the next 5 to 10 years?
Yeah, the U.S. has had an incredible run. You can see our portfolio, even our U.S. exposure, has grown over the past year because the U.S. has delivered really strong returns.
Mm-hmm.
U.S. today is about 70% of the global capital markets. We have kind of mid-40s of the portfolio in the U.S. We actually are pretty comfortable with our allocation to the U.S. right now. We continue to believe it's important to be diversified globally. It's important to continue to have exposure into the U.S. It's a big, liquid capital market. And at our kind of allocation, we're pretty comfortable.
There is always political pressure, but seems like new political pressure to ask the big pension funds in Canada to invest more of your money at home in Canada. What do you think about that kind of sort of allocation requirement?
Well, we're always looking for opportunities in Canada. One of the things I highlighted in my CEO letter in the annual report is we have 114 billion of gross assets invested in Canada. And we have teams that are dedicated to looking for more investment opportunities in Canada. We have an appetite for Canada in the portfolio, and we're actually really encouraged, and we're really, frankly, excited about some of the potential for opportunities to invest in large-scale infrastructure, energy, oil and gas, pipelines, renewables. Some of the discussions that are happening at the policy level. We think this is going to generate some really interesting opportunities that are all consistent with where we started the discussion, and that's ensuring that the CPP is sustainable for another 75 more years and really driving great investment returns.
So open to investments here, but how would you feel about a policy mandate that you invest a certain proportion of the fund in Canada?
Yeah, we are, as we've always looked at it, we're a pension plan. We were created 25 years ago to solve what at the time was an issue with the plan. And over that time, as I mentioned earlier, we got 12 million as the first check. We have 714 billion today. And our mandate as enshrined in federal legislation is continue to maximize return without undue risk of loss. And we'll continue to do that for the 22 million Canadians that look to the Canada Pension Plan.
One of the things, of course, that changed, and it may have prompted that increase in benefits back in 2016, is the number of Canadians not covered by pension plans through a company, a private plan. Could you foresee a scenario where the plan should be broadened, where it should welcome self-employed, where it should up the benefits? In other words, kind of I know that you'll say this is a policymaker question, but would it make sense, given the size and value of the income you're able to generate, to be more generous with it with Canadians?
Yeah, I think you anticipated my answer on that one. Is when it comes to setting the contributions and the benefits, we look to the provincial finance minister and the federal finance minister, and we are here at CPP Investments to invest the funds that they give us, consistent with the mandate they provided us. And as we highlighted on the performance, I think we've done a pretty good job.
You have done a pretty good job. I think second in the world. You certainly have a lot of clout in the world, given the size. You mentioned that you have, decent exposure to the U.S., but just under half of the assets are focused there. Can you see that shifting as you look ahead? Are there other regions where you would expect to grow exposure?
Yeah, it's a good question. And I think we're always looking at our geographic exposure. We built out a global portfolio, and there's a lot of volatility. There's a lot of kind of uncertainty or instability in the markets today. But as you think about investing, if you're going to pull money out of one geography, you got to put it somewhere else. Mm-hmm. And if we back up and look at some of the impact of this volatility, we think it's going to impact global growth, and it's going to, and everybody is going to feel that impact on global growth. So we are looking at our geographic allocation, but we see that this growth impact will be global. And where we sit with the U.S. right now, based on the size of the market of being such a big part of the global capital markets, very big liquid markets, sitting in the mid-40s is somewhere we're comfortable with. It may ebb and flow at the margin, but I wouldn't expect any big changes.
All right. Unfortunately, we got to leave it there, John. It's great to have you with us for this.
Great. Thank you.
John Graham is president and CEO of the CPP Investment Board. Coming up, do Canadian steel producers need a new market much closer to home? That's still ahead. Canadian steel has been in the crosshairs of U.S. tariffs for years, back to 2018 before NAFTA was renegotiated. Now suffering again, is it time to consider a new strategy for the Canadian steel market? Michael Garcia is CEO of Algoma Steel. Thanks for being with us.
Thanks for having me, Amanda.
So let's start with how you're doing. I mean, this has been a long haul, and for steel producers like you, this isn't new, but hardly welcome. How is business these days?
Business is extremely challenging. We're caught between a rock and a hard place. We are facing a 25% tariff on every ton of steel that we sell to the U.S. market. That's about half of our order book. It was as high as 65% in the past. We've worked that down to half. But the other rock that we're facing is the soft Canadian domestic market, which has a relatively good amount of steel demand, actually a little bit more steel demand than steel produced domestically in Canada. But the problem is it's being overrun with foreign steel. Now that steel can't go to the U.S., any steel from anywhere in the world is paying a 25% tariff into the U.S. So that's causing a lot of steel to be diverted into the Canadian market. And between this rock and a hard place, it's an extremely challenging environment for Algoma Steel right now.
Where is that foreign steel coming from mainly? Is it from China, which has been a concern of the U.S. for a long time?
It's coming from China, partly, even though China is paying a 25% duty on steel. That's the only real duty that's in wide effect for foreign steel in Canada. But it's coming from China, it's coming from Vietnam, it's coming from the Middle East. It's coming from Vietnam, China, but also it's coming from the U.S. The Canadian government did impose a 25% duty on U.S. steel, but so many buyers of Canadian steel in Canada have applied for exemptions that the government has actually granted a blanket exception for the time being for anybody who is buying steel in Canada that claims that steel is a critical raw material that they can't get elsewhere. So that's really causing a very difficult market situation for us here in Canada. And these exemptions that have been granted by the government are really part of the problem right now.
So that sounds like a big part of the problem. And of course, do we have tariffs in place that would make a difference to you against countries like Vietnam or the Middle East? Are we actually protecting our domestic producers properly?
Not right now, no. There's too much foreign steel in Canada. It's making it very uncompetitive for us to simply turn our eyes to the domestic market. Even though we are Canada's only producer of domestic plate, for example, we are facing competition from U.S. plate, from Turkish plate, and it's making it very difficult for us to survive these current market conditions for long.
I have to ask you, it feels like we're in a new era of protectionism. In the old days, we would have said, well, businesses should get the cheapest steel they can. That'll be good for the economy and for customers. Mm-hmm. Are those days over? Are we now in an era where we have to think about protecting our domestic production because that's the only way to make sure we have it?
Correct. I think Canada needs to come to terms with the fact that a vibrant, sustainable domestic steel industry is critical to the future of Canada. I was just looking before our call about the key priorities that Prime Minister Carney shared with his cabinet ministers. Mm-hmm. There's 7 key priorities. A domestic, vibrant, sustainable steel industry plays a role in almost every one of them. Maybe we don't play a role in leveraging artificial intelligence, but if we're going to establish a new economic and security relationship with the U.S., if we're going to build one Canadian economy, if we're going to enhance national security and sovereignty, if we're going to build the type of infrastructure that Canadians want and realize is important going forward, if we're going to survive global shocks, and whether it's a geopolitical shock or a supply chain shock, we have to have a vibrant domestic steel industry. If we're going to make things more affordable to Canadians, part of that is that Canadians have high-paying, good, sustainable, secure jobs. The steel industry supplies those type of jobs. So we can't have the type of Canada that the Prime Minister wants to build, that all of us living in Canada want to see in the future. We can't have that without a strong steel industry. And I do think it will take some sort of proactive measures by the government to put the things in place that protect that steel industry.
All right, only a few seconds left, but is one place the government could also help you on procurement? Do we emphasize buying Canadian when it comes to steel?
We talk about it, but there's so many examples where we're missing the opportunity. There's two large polar icebreakers that are being procured by the government. It's I think it's a $6.7 billion procurement. There's no Canadian steel being used in either of those two icebreakers. Right. We could make the plate that goes on those icebreakers. There's a bridge in Quebec province, the Ile d'Orleans Bridge, $2.7 billion investment in the infrastructure of Canada in Quebec with a brand new bridge. We can't find any evidence that there's going to be any Canadian steel on that bridge or any Canadian contractors and a Canadian supply chain involved in the majority of those infrastructure projects. Those are the type of things we can't afford to do going forward as we build Canada. We have to address that. I believe the message is there. I believe going forward we will be able to do that, but we're watching very closely and we're after those type of opportunities.
Got to leave it there, Michael. Thanks for being with us.
My pleasure, Amanda. Thank you.
Michael Garcia is CEO of Algoma Steel. Time for the takeaway and delivering a hard message. Workers at Canada Post are once again resisting demands to make some changes at the Crown Corporation. And with a strike notice officially in place this week for the second time in 6 months, their customers are braced for another work stoppage. The notice on behalf of the mail service's 55,000 employees came Monday, at which point Canada Post said it would not accept new items for delivery. The issues between Canada Post and its workers are hardly new, but the negotiations are still stunning all the same. While the union balks at contract workers and weekend delivery, Canada Post reports loss upon loss. And a recent assessment of its business from the Industrial Inquiry Commission said Canada Post is effectively insolvent and recommends dramatic changes to its delivery model. That includes ending daily delivery of mail and removing a moratorium on new community mailboxes and closure of some rural post offices. The report is stark in its assessment of the future if adjustments aren't made in a hurry. The union pushed back on that view, but is still faced with the grim reality that daily mail delivery just doesn't represent the same volume it once did, and that formerly lucrative city routes no longer subsidize rural ones. While a strike is one of the tools in a union's toolbox, it can border on self-harm when a business is this weak. That this is a government-backed business should not mean it's a bottomless pit of cash. Canadians have a different relationship with mail today than they did a few decades ago, and Canada Post's most successful business, which is its parcel delivery system, could be liberated from the albatross of a moribund mail service. This is an opportunity to rethink the place and what it does. And yes, that might mean fewer jobs of some type or even overall, but that happens in business all the time. My takeaway? Change is hard, but when change is necessary, doing it involuntarily doesn't make it easier. That's Taking Stock for this week. I'm Amanda Lang. Thanks for being with us.